Shocking report reveals more manipulation of government data. I'm your host, Steven Van Metre, and thanks for joining me today. And while many of you won't be surprised to find out the government's cooking the books, what you might be surprised to find out is how this will have negative implications for government policymaking and your investments. Let's kick this story off as we head over to the BLS website, who announces today that the January 2022 CPI weight update that's starting in January 2022 weights for the Consumer Price Index will be calculated based on consumer expenditure data between 2019 and 2020. The BLS considered interventions, but decided to maintain normal procedures. And what this means is they're going to look at the parts of the CPI that went up the most and increase their weighting towards it, meaning the CPI is likely to go higher, but let's dig deeper to see if we can find out just exactly what they're up to. What we see here is the 12-month percent change in the Consumer Price Index for all urban consumers via selected items not seasonally adjusted. And I've marked out the years that don't count because they're going to adjust their weights based on these 2 years here. And the highest ones are going to be gasoline, used cars, energy, pipe gas service, food, new vehicles, and tobacco and smoking products, along with household furnishings. And let's get deeper into this because let's start out with crude oil, which has a huge impact on energy costs and gasoline. And what do we see? That while the price is high, that's not the issue for the Consumer Price Index. It's the year-over-year rate of change, which is running at a whopping 66.5%, indicating that we're going to see likely higher energy prices in the CPI, meaning the CPI from an energy perspective is probably going higher. But let's keep going because it gets even worse as used car prices arrive at yet another major inflection point. According to Zero Hedge, the Manheim Used Price Value Index, a wholesale tracker of used car prices, rose to a new record high in January. Prices of wholesale used cars continue to move higher. Still, there are emerging signs as momentum wanes on a monthly basis, which suggests another potential inflection point. This one may actually be credible in light of growing speculation the supply chains are easing as chip shortages may improve. But the issue with the CPI, it's a lagging indicator, so it's always looking backwards. And again, that means due to high used car prices, well, we're probably going to see higher Consumer Price Index. Let's keep going. As we head over to pipe gas, we'll look at the Henry Hub natural gas spot price, which is not anywhere near recent highs looking back to the great financial crisis, but is still relatively high. But again, from the Consumer Price Index perspective, what matters is the year-over-year rate of change, running at a blistering 61.6%. And those big increases that you see here are going to feed back into the report. And how about food? Of course, we all know as we go to the store, food prices are higher and pesticide prices are rising, hindering farmers with more costs. This headline by Bloomberg, as costs for materials used by the agricultural industry have risen during the last several months, putting strain on producers and raising concern for further inflation when food prices are already near record highs. So as we can see, these revisions by the CPI, by the BLS to the CPI are going to likely lead to higher consumer prices in the report. And of course, that will have major implications for policymakers. But guess what? That's not the only increases you're going to see in the report, because you're going to see something impact your wallet here pretty soon as Wall Street Journal headlines that car insurers rush to raise rates as inflation takes toll. Insurance pass costs back to consumers as inflation boosts prices for car repairs, replacements, and rentals. And many insurers are boosting premiums by 6 to 8%, while some are going to ask for double-digit increases, according to industry executives and analysts. The rising rates are an example of inflation leading to more price increases as businesses try to compensate for higher costs. And after having a stellar year when lockdowns kept many drivers off the road, insurance struggled in the second half of 2021. Auto insurers posted dismal fourth quarter results and laid out plans to raise rates. And during 2020, many insurers gave consumers rebates and some modestly reduced rates. So again, we're starting to see other impacts on your budget. Of course, as we know, as the Consumer Price Index stays high, what will that mean for the Fed? Well, it means they're going to have to make policy based on what the BLS says. And let's check out this headline from Bloomberg, as hot inflation data risks pushing Fed closer to a supersized hike, and greater than expected CPI could pressure a 50 basis point move. Fed policymakers usually prefer to move gradually at liftoff. And as we know from prior Fed rate hike cycles, well, while the stock market can keep going up, when it does stops, it usually has a major move down. And if you're concerned about what this would have an impact on your portfolio, well, you shouldn't be. Check out Portfolio Shield. There's a link up above and in the description below. You'll be glad you did. Let's keep going with a story, because Bloomberg goes on to say the January Consumer Price Index due Thursday is one of the most important data releases before the central bank's March meeting, which Jerome Powell has signaled will kick off a series of interest rate hikes. A reading above projected 7.2% annual advance in prices, which would be the largest since 1982, may pressure the Fed to consider its first half percentage increase since 2000 instead of the normal quarter point move. Powell indicated last month he wouldn't rule out a half a point hike, and after unexpectedly strong January jobs report in which payrolls beat all estimates and wages jump, traders are all the more convinced that the Fed will be aggressive. Based on federal funds futures, they now see a 1 in 3 chance of a 50 basis point hike, up from a 1 in 5 before the employment data. And well, what does this mean for consumers? Well, unfortunately, that's not good news. Let's keep going. Even so, it's a risky move for Powell, who's awaiting confirmation to another 4-year term at the helm. Critics say the Fed has been too slow to act and is now behind the curve in tackling inflation, and a half-point move could be perceived as admission that they're right. And of course, we all know that the Fed is behind the curve, but from a consumer standpoint, they're already seeing tightening effects in their household budgets. And so what is their first move they do? Well, they first start to finance the higher prices. And if they stay sticky or their wages don't increase fast enough, then what happens is you see consumers cut their spending. And what do we see in this recent report? That Americans ramp up credit card spending and return to old habits. As the New York Fed report shows, new mortgages reach historic highs, auto loans soared, reflecting a surge in car prices, and credit card balances increased every quarter in 2021 to end the year at $856 billion, according to the Federal Reserve Bank of New York. The fourth quarter gain was the largest in figures dating back 22 years, and while the total amount is still below pre-COVID levels, the gap is closing rapidly. And the average credit card charges is 16.28%, according to Bankrate. That could easily be over 17% by the end of the year. Roughly half of credit card holders carry debt from month to month. This is really expensive debt, and all that's going to do is add to consumer budgets. And without stimulus to help them pay those bills, well, that means less money being spent on discretionary goods and services. But that's not the only place debt went up. New mortgages reached a historic high last year as auto loans soared, reflecting steep price increases in homes and cars. The regional Fed also said in its quarterly report on household credit and debt, as prices of new and used cars have soared, buyers have borrowed larger amounts to finance the extra costs. This will create a longer-term financial burden for households stuck with large loan payments, even as prices of used vehicles start coming down from their peaks. And this is especially a risk for those borrowers who would find themselves owing significantly more on their cars than they're worth if and when used car prices normalize, particularly as the increase in used motor vehicle prices may prove unsustainable, as New York Fed economists mentioned in their blog post. Of course, we know that many people are buying negative they're taking out larger loans than their cars are worth. And of course, that will have an impact if car prices go down and their wages can't keep up, could lead to a subprime auto crisis. Now, on a continuation of our story from yesterday, many of you were really appreciative how we talked about why the government auctions remain strong despite higher interest rates and higher consumer price index. And today, well, we had the 10-year auction, further validating the story that higher inflation leads to higher foreign demand. But what I want to show you in here is not just the data, but what other people look at and see this means to them and why they're wrong. We'll head over to Zero Hedge, who says, blowout, 10-year auction sees huge buy-side interest, record foreign demand. In short, this was a stellar auction, and one which may be reflecting not just the economy's prospects in the medium term, hardly a runaway inflation outlook, and if anything, bonds are saying the Fed is well ahead of itself again, but also speculation that tomorrow's CPI print will be a miss and will send yields across the curve sharply lower. And of course, we know that that has nothing to do with it. It has nothing to do with the CPI report. Now, the CPI report could be higher, could miss expectations, has nothing to do with foreign demand. But now you know that. Let's take a look at the data from today. We see the 10-year Treasury came in at 1.9%, but that's not the big deal. The big deal is 77.6% of the auction, or about $28.7 billion, was taken by foreign bidders. Note the dealers took, I believe, one of their lowest or the all-time lowest take at $2.75 billion. And why does that matter? Well, dealers are currently short the 10-year. They are shorted inventory by $4.86 billion. So after this auction, auction, of course, dealers will still be short. And why are they short? Because everyone's betting on higher interest rates, and the dealers don't have enough inventory to provide all these short sellers. Of course, that just tells you when interest rates do collapse, as we talked about they're going to, well, that means there's going to be a lot of people covering their bond shorts and leading to much lower interest rates. And with that, I'm Steve Van Metre. Appreciate you being fans. Appreciate you watching. We'll see you soon. Bye now. The content of this video provides educational information only. It's not intended to provide investment or advice. It's not to be construed as recognition or solicitation by a security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steve Van Metre. Personal capacity. Opinions expressed in this video that do not affect the value of Steven Van Metre Financial.